Welcome to the show, Be the Boss of Your Money. This is about helping you to take control of your money. Sometimes the best decision when it comes to money, financials, investing, sometimes the best decision is no decision. But we want no decision to be a conscientious choice, not because you ignored things and therefore made no decision because you either ignored things or were paralyzed by fear or were just going through so much information overload. So, what I want to do here is every day, I want to help you break down your personal finance, your investing, the market, so that you have a better understanding of things. Because when you have a better understanding of all of those important things, those topics are super important. What it means is you are more likely to be more rational, not relying on hasty decisions, acting on fear and greed and emotion. These stocks or this asset class is going up, I better jump in. This one's about to go down, I better jump out. You read something maybe that someone says the stock market is going to go through a severe correction, like severe, like 90% down market. And that's scary, could scare, that could be scary. Then you read someone else who says market could triple in the next, X amount of short amount of years, and you read everything in between. But if I just say, stay cool, stay the course, let's look at where things are, let's make sure we're just acting in your best interest based on what you need, what you're trying to do, it's actually very boring. We find our own personal finance needs and the information that we need to take in for our own personal finance, we find it very boring. We look outside for interesting things to look at. But I want you to know I like boring, and I want to tell you the important things you need to look at. So let's take a look at a couple of things. Quick question about the FAFSA applications to answer for you. And we'll take a look at, is the breadth of the stock market really a problem? And I want to welcome all of my new YouTube subscribers. Now, whatever channel you're watching on, whatever platform, it could be on LinkedIn, could be on Facebook, could be on YouTube. If you don't mind, give us a thumbs up, ask your questions in the comments. I love hearing from you. It's the best part about what I do. And I only want to see you do well. There's nothing to sell, no hidden agenda. Of course, if you are looking for a new financial advisor, you are welcome to reach out to me and inquire and see if we're a good fit. If I can help, great. If I can't, I can't. I've got plenty of clients and a nice clientele, and we're in good shape. We're always open and welcome to new clients if we're the right fit. You should feel the same way. You could be open to a new financial advisor if he or she is the right fit. Having said all that, let's roll the intro. We're going to talk about these. I'm going to look at the major indices from small cap, large cap, real estate, gold, etc. And we'll take a look to see what's really working out this year and why some of you who are in asset allocation models might be scratching your head and saying and asking, how come I'm not doing better? I'm lagging the market. We'll talk about that too. So here's the intro. Stick around. This is going to be quick. It's going to be good. All right. Thank you for joining me. First thing I want to get out of the way is just to, I get questions about the FAFSA, the free financial aid. Every student who's going to college fills it out every year. So typically, most people fill these out 4 years in a row. And it's important to do. You might not necessarily get anything, but even for merit based scholarships, you will still need to fill out the FAFSA form. You never know, but it's not just based on income and assets. These are based on family size for getting financial aid, Pell Grants, things like that. So it always pays to fill them out. But the question is, when parents go through assets, they're wondering a couple of things. Do cars count as an asset? No. They want to know about money assets, investing, cash, CDs, savings accounts. That's what they want to know in real estate. So if you buy a car for your child, or if your child saves up and buys a car, and you're filling out the FAFSA form for them or helping them fill it out, and they're going to be asked what are their assets, you do not have to list the car. That does not count in a FAFSA application. Now, if you are one of these generous parents, you buy your kids a car or cars. And so if you buy your kids cars, here's the question to ask yourself: should you even have the car in your name then? In most places, most states, most companies, they could still be in your insurance. The key is this: kids are not such good drivers. And maybe not your kid, but most kids are not good drivers because they lack decades of experience of driving an automobile. And if the car is in your name, your child gets into an accident, you are on the hook for damages because it's your car. You have assets, you're a target, not the kid really. They want, the lawyers who sue, who help their clients sue, they want your assets. They're going after you. So I think in that regard, it does pay to move the car into your child's name. And if you decide you want to pay for their insurance, you still could. You could still be under the same insurance policy in most cases. But by getting the car out of your name, you could be saving yourself a lot of aggravation and a lot of money from lawsuits. So these are the kinds of things that you could do. You could also have an umbrella policy, which I highly encourage anyone who has young drivers in the household to have an umbrella policy. That just really ups your insurance, your liabilities, and I think it's super important to have that. And umbrella policies are typically very inexpensive. Okay, so that's enough about FAFSA and cars. When does the Fed meet again? The Fed will meet. Let me just punch up my screen here. Okay. Can you see that? So the Fed's upcoming meeting, their next meeting is actually this week. They meet tomorrow. They have a 2-day meeting tomorrow, June 11th, and Wednesday, June 12th. And June 12th, around 2:30, they'll come out with their statement of what they're doing with interest rates, and then there'll be a presser, and Federal Reserve Chairman Powell will make a speech, give his bullet points, and answer questions. But no one expects the Fed to do anything this week. No one expects a cut, a raise, nothing. In fact, odds are that we might get an interest rate cut in November or December. Keep in mind, that's right around the presidential election. So if the Fed wants to cut, a lot of people are thinking if they want to do something, they're going to have to do it by the 17th, or they'll have to wait till December, by September 17th, 18th, or they wait until December. So a lot of people are trying to figure this out. What I want to tell you is this. Everyone said if the stock market, if the Fed raises rates, okay, let me just change my screen here. If the Fed raises rates, what everyone is saying is that, boy, I want to hit the wrong button on my consoles here. Everyone said that if the Fed raises rates, it hurts the stock market, and that generally is true, except the stock market has been hitting records. In fact, today, we hit new records in the S&P 500 and the NASDAQ. Now, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. But overall, whether if you're in large cap stocks or not, you shouldn't be doing too badly. And the economy hasn't gone off a cliff yet, but there are signs of weakness in the economy. Keep in mind that when interest rates were lower, there were also signs of weakness in the economy. Keep in mind, even in a strong economy, there are going to be signs of weakness. So when people say the economy is good or the employment figures came out last week and they were much stronger than expected, but there are weaknesses in the economy, I do see weaknesses developing, save it. Put a sock in it or just cover up your ears like this, because there's there's always a problem in the market. There's always something to worry about in the economy, and things will never be perfect across the board. When that day does happen, that'll be the day you probably want to sell everything. And since I don't expect that day to ever come and everything is perfect for the economy, the stock market, I don't think you'll ever get to the day when you want to sell everything. So that is something to keep in mind. There's always something to worry about. More government jobs and private sector jobs, for example, or wages are still too high, with the unemployment rate is starting to go up. We wanted the unemployment rate to go up, but now when it goes up, people get nervous about that. Nevertheless, investors came in today after digesting last week's employment figures and said, I want to buy, I want the stock market to go up. And they were right, and they went into it, and that's what happened. So trying to call the market based on one data point in a mix of good data points is really, in my opinion, a waste of time. There are also so many people that are looking at everything through a political lens. Well, some people are probably upset that the labor numbers are good because they think it'll help them politically. Some people are happy about it because they think it'll help them politically. You know what? I take all of that stuff, I move it aside, and I say, hey, these are the statistics based on this. Based on that, I can see what companies could do, what the Federal Reserve could do, what interest rates could do, and what inflation could do. I still don't really see much of a reason why inflation would go down much lower. It did go from 9 to about 3% and change, but it's really sticky over here, and it's very hard to squeeze out that last drop of inflation. And I don't even know if it's worth going for that, because one of the things that led to low inflation over the last 30, 40 years was moving production offshore, taking money away from high wage American earners and putting money into the hands of low wage international foreign earners. And as that reverses, we start reshoring production, onshoring production. That's going to start to cause inflation to go up. And I don't think it's a blip. I think that's the kind of thing that is long lasting. So I'm rather impressed with how low inflation is. And I don't think the Fed keeping interest rates higher is actually going to be a help in terms of fixing inflation. It's really so many other things drove inflation down. Remember in 1980, Paul Volcker raised rates a lot. People say he broke the back of inflation. But underneath the surface, that's when the first PCs were introduced to office environments, and that started a wave of massive productivity. And then the internet, productivity in the 80s, internet in the 90s, right? Computers 80s, connectivity in the 90s, and that continued into the 2000s. And now we're looking at artificial intelligence. So lots of things to keep inflation down, but lots of things now to keep inflation up. 20 years ago, production was moving overseas. Today, production moves closer to here. So these are the things I like to watch, but I don't fixate on inflation and interest rates. I'm really a long-term investor. And based on what we've seen with higher interest rates, higher inflation, the stock market has been doing just fine. So if the market goes up on higher rates, which it has, it's at record highs now, then it should go higher on lower rates. Well, which is it? So basically, however you see the tea leaves, interest rates up, oh, the stock market goes up. Interest rates down, oh, the stock market goes up. So if that's how you see it, that's fine. Most years, the stock market is up. Over the long term, the stock market has had a general upward bias and a lot more up years and down years. But the thing is, we don't know exactly what order those up years and down years are going to come. I think the next 10 years will have mostly good years in the stock market. I just don't know if it's going to be year 1 through 10 for the down years. We don't know that in advance. This is why we invest for the long term. And when we have a cash need coming up in around a year or two, we want that money to already be set aside in cash. So if the market does go down, you're not forced into selling into a lower stock market with lower prices. Therefore, you have to sell more shares of whatever you have, stocks or exchange traded funds or mutual funds, to get the same amount of money. In fact, if somebody has a really big goal, like a down payment on a home, that money's in cash, sometimes years in advance. It doesn't pay to invest it because we can't really afford to take a short-term loss, even if we think the stock market can go up over the long term. That's it in a nutshell, right? That's your risk tolerance right there. That's how we do it. And if you notice, it has nothing to do with whatever anyone has to say about the stock market or artificial intelligence or anything like that. Having said that, I want to take a look at a couple of stocks here. All right. Let's get rid of this. These are the big stocks. Meta was up almost $10. Amazon was up. Microsoft had a really good day. If you notice, Meta was 500. It went down to about 420 about 3 weeks ago, and it's already back up to 500. What a steal that was. That was a gimme when the stock tanked on earnings. They had great earnings. I mean, it was really hard to find anything wrong with it, and I was really surprised at the reaction of the stock going down, and we thought that was an overreaction, and I'm glad we thought that because we got in there and bought with both hands for the right clients. But Amazon, right near highs, Microsoft, well, back into the 400s. NVIDIA had their 10-for-1 split. If you notice, it's $121.79, not 12,000, not 1,279 at this time. So Netflix was up. Google is up. Apple's not far from its highs. Tesla's really only one of the mega cap stocks. It's just doing lousy. And, Tesla has a problem. They're being viewed as a car company now, not as a self-driving technology or artificial intelligence company. So once that happens, it's really hard to fight it. And that's the dilemma they're in. And there's so much competition now in EVs that people are wondering how Tesla's going to fare. Plus, the CEO wants a $60 billion pay package, and a lot of institutional investors are voting against it, as I think they should. I mean, $60 billion pay package for a guy that's already one of the richest men in the world is kind of ridiculous. It just speaks to me of greed. To me, it's like not the right thing for Tesla shareholders, but that's him. Apple was down today, even though they have the WWDD, the Worldwide Developers Conference, WWDC, where they unveiled all kinds of new technology, artificial intelligence, using OpenAI. And that's good, except Apple is now viewed as a company that has to, Apple is now being viewed as a company that has to outsource their hottest technology. And if Apple cannot be viewed as an artificial intelligence company or platform as far as their products go, I don't think the stock can be as valuable as it is now. If you don't have a really solid artificial intelligence strategy, you have nothing. Just like 25 years ago, we used to say, if you don't have an internet strategy, you don't have anything. Today, if you don't have an AI strategy, I don't think you have anything. And I think that's why Apple is just struggling to regain its footing and come back to all-time highs. And it's now going to be viewed as a mobile phone maker that has phones as good as everybody else, and everybody else is as good as Apple. And it's really tough to see the premium without something really, really special with artificial intelligence. And they're basically outsourcing that job to OpenAI. So that's a problem, I think, for them. And, caveat is I could be wrong. All right, now let's take a look at a couple of other things. The S&P 500 is up. Let me pop myself up on the screen here, okay? I should have been there the whole time. The S&P 500 year to date. Let me make this a little bit smaller. The S&P, can you see that now? Let me make this a little bigger because this is a pain in the neck. All right. The S&P 500 is up 12% this year. Now, a lot of people think, it's interesting. Some people think the market's down this year. Some people think it's up more. Everybody's all over the place. But just about midway through the year, all right, a little bit past we're not even to the midpoint yet. We're not done with June yet. So the market's up 12 points, 12%. If you take a look at that and compare that to small caps, the Russell 2000 index is the standard small cap benchmark. That is only up 0.22% for the year. So large caps are just crushing small cap stocks. And then you take a look at the EEM, that's the emerging market, the popular emerging markets ETF, tracks emerging markets. Let's see how that is for the year. That's up hardly at all. Looks like it's flat for the year. I thought it was up a little bit. Am I wrong? Forget that chart. Okay, so I think it's basically flat for the year. I'll I'll stick with that for now. Why is it going to that? EM. Sometimes you lose a quote. I'll get a quote in a moment. That is just not cooperating. So here you go. EEM, emerging markets up 5% on the year. I'll just close that one out. The EFA, that's Developed Markets International. Developed Markets International is it's up 7.78%. It's okay, single digits, not as good as the American S&P 500. Gold, all these extra screens up today. I want to get rid of them. Gold is up a little over 9% on the year. Some people think it's up more than that, but I don't. It's not. Real estate, IYR tracks U.S. REITs. That is down for the year, down 5%. So what does all that mean? It means that the stock market is being carried by the largest individual stocks. And you know what the names are. We've been talking about them for years. It's always Meta, which is Facebook, Alphabet, which is Google, Microsoft, Apple, Netflix, and now NVIDIA. NVIDIA was up a little bit post-split, as we went over before, just a little bit. So does this mean that the stock market is too narrowly led? Here's the thing. The best companies are leading the way. The biggest companies are also showing the biggest growth and the consistent growth. And the nature of their technology means that no one's catching up to them, because once you have a lead in technology, you actually use your technology to expand your lead. That's the bullish thesis. The bullish thesis for artificial intelligence is eventually the artificial intelligence gains are going to move from a handful of big tech stocks to the rest of corporate America. So your typical companies like Target, like Costco, like General Motors, like Delta Airlines, these companies one day will be using the artificial intelligence tools that are being developed by the tech companies. Just like we had internet stocks, and then eventually corporate America fully adopted the internet. I know every company today is an internet company. And in 10 years, every company is going to be an artificial intelligence company. These are going to take time. And I can give you the bullish thesis like I did. But I could also say that NVIDIA is also worth $3 trillion. It's a massive mind-boggling number. And if someone had $3 trillion to invest in AI, they could buy NVIDIA. I don't mean no one has $3 trillion. It's just $3 trillion is the value of all the shares combined. So are we hitting the law of large numbers? Microsoft and Apple exceeded $3 trillion, and they're having trouble getting any gains in their stocks after that. We'll see if that happens to NVIDIA. But just because the market has narrow breadth, meaning it's being led by a small handful of stocks, does not automatically translate to it's a bad market because it's got narrow leadership and it has to go down. There's a reason why the leadership is doing so well, and I don't subscribe to narrow leadership automatically means an overpriced market or a market that has to go down. Now, markets could go up and down for many reasons. If the market goes down and these stocks go down, someone will say, you see, I told you the market breadth was too narrow, leadership was too narrow. And if it goes up, someone will say it doesn't matter. I say, pay attention to your personal finance Invest according to your risk tolerance. Make sure you are diversified, which is a strategy that we use to. It's a strategy. Well, it's a strategy that doesn't necessarily minimize risk all the time, but it does help mitigate risk in a generally down market. It won't mean you won't have risk. It just means you might have a little bit less risk. In a generally down market, your account could still go down, even if you're diversified. So it's not like a magic elixir to be diversified. Go, you can't go down. I remember people used to say, "No, I'm very diversified. I have my money in the S&P 500 index fund." I'm like, that is not diversified, and it's a lot less diversified now than it was 10 or 15 or 20 years ago. And it's basically, to me, a tech index, which is what people mean by the leadership in the S&P 500, as also used interchangeably with the overall stock market. It's very narrow. Just a handful of stocks are leading it higher. We'll see if it means something. I think the city will make a prediction that it automatically means something, that either those stocks have to go down or other stocks have to go up to catch up to it. I don't think the stock market has to do anything. You bide your time and invest for the long term. I wish I could give you a more definitive answer, whereas to say it does mean something, it doesn't mean something, but I'm not trying to get on TV with this, because I kind of have my own TV show right now with the live stream, right? Right. But what I am saying is, pay attention to something else. If you're worried about the market going down, it means you might be invested too aggressively. You might be going in a little higher than your risk tolerance is. And maybe you should scale back stocks and increase your fixed income or cash allocation. But that has more to do with personal finance and making a decision based on whether or not the stock market is up too much or too little based on a few large cap stocks. That's the story. And thank you so much for watching. I hope you enjoyed the show. If you watch this in the replay, keep going and ask your questions there. Reach out to me if you can use some help. All right. Take care. Thanks.